JP Morgan Chase and other large banks are preparing for this upcoming recession. Are you? Chase has recently set aside over $1 billion. Bank of America, Citigroup, and Wells Fargo set aside hundreds of millions of dollars to prepare for people not being able to pay off their loans. So what does this mean for you and the housing market and other sectors of the economy? When you see big banks making moves like this, you need to start thinking for yourself. You need to prepare and make sure you're safe, because if these big banks are making sure they're okay, they're not going to care about the average day consumer. You as an average day consumer need to prepare for yourself. You have to set aside money for this upcoming recession. You have to set aside money because inflation is still high and the cost of your basic necessities are super high, like food, housing, and other staples. Now, in my last video, I talked about commercial real estate and its impending doom that's happening in that segment class, how a lot of these commercial real estate have loans being due within the next 2 to 5 years. And these are trillions of dollars that are due with higher interest rates. So if a bank or a company would go and sell their commercial real estate loans, their loans are not as attractive because of higher interest rates. And so they would have to lose out if they would have to sell those loans, or if they refinance those loans, their monthly payments will be higher. And so this has a rippling effect, not only on the real estate market, the residential market, but also the economy as a whole. In today's video, I'm going to talk about what's happening with the banks and its effects on the housing market, the economy, and what you can do to better prepare for yourself. We're going to go over different charts and different articles just to show exactly what's happening in the economy right now. Please be sure to subscribe to the channel for some more content around the housing market, personal finance, and the economy as a whole. JP Morgan Chase, the nation's largest bank, raised the risk of a mild recession to arrive later this year. So this article was written earlier this year, and they are saying this: the largest bank essentially in the world has talked about a recession arriving. Talking about the housing industry, looking at Wells Fargo, once the nation's largest home lender, they started to reduce their staff in its mortgage business, which suffered a sharp drop as high borrowing costs have spooked buyers and stalled the housing market. So you can imagine these big banks, they're understanding what's happening in the housing market. They're not going to be as invested in their mortgage business right now because they know they will be losing money. Not only because there's less of a demand, but also because people who have loans with them are going to go into delinquencies because people cannot afford the houses that they bought a year ago when interest rates were lower, but the price of their house was higher. And so with these higher interest rates, with everything being more expensive, food, household products, and other necessities, people are going to start increasing their delinquency rates. You're going to see more delinquencies in the housing market, more pre-foreclosures, more foreclosures happening. Another thing that these banks are saying is that people are reading the same headlines we're all reading about a recession is coming and they should be careful. So if you see these big banks preparing, putting money aside, you as a consumer, you should set aside money just to prepare for the storm that is going to happen starting later this year. Now, to the degree that some people are saying, I'm not sure. I'm not predicting a huge crash, not even as severe as the last one that happened in 08 and 09. I do predict a milder crash, but you still have to prepare for yourself because inflation is still high. The cost of living is still extremely high. Now, I want to show you all this chart of all deposits in all commercial banks over the past 25 years. You see this happening right now, this dip happening in deposits, right? We're talking about banks. They use our deposits to invest and to make money. And so when you start seeing a decline in deposits, that's a telltale sign that we're coming into a recession or things are not going that well like they should be. But something interesting I want to point is that during the last recession, there wasn't any huge dip or drop in deposits happening in commercial banks, even though some banks had to be bailed out, but you didn't see a huge drop like you're going to see, or like you're kind of seeing right here. This is a actually significant drop for deposits happening because people's income increased, inflation increased. So of course, overall, this chart will always trend upward. But looking over the past year, you see this huge drop that's happening in deposits in commercial banks. And commercial banks include smaller banks, banks, and it includes like your larger banks like Bank of America, Chase, and Citigroup. And so you're seeing that dip happening. And like when the pandemic first hit, you saw a huge increase, and that was mainly because of the stimulus checks and everything happening. Will we see these deposits start going back to 2019 to, I guess, that level? Because the Fed just printed money into people's accounts. And so that's why you saw this huge jump. And hopefully banks are not being so risky with the deposits that we're actually giving them to use. And so I just thought this chart was interesting, just showing how this trend so far is trending downward when usually it goes up. Like, to me, this is a significant drop for a chart that didn't really ever have significant drops like that throughout its history to that degree. Now, a few weeks ago, JP Morgan Chase said that the Fed is facing a difficult task when they were about to raise interest rate again. They're saying that, we're at the point of no return. Like, inflation is here, the recession is here. If you're expecting a soft landing that the Fed wants to do with the market, I think we're past that time. And that's what the largest bank in the world is saying. It's interesting to know because I think the Fed, for a while, they tried to do this soft landing. But in doing so, I think it hasn't really accomplished what it wants to accomplish into really resetting the economy so we can go back to normal levels of inflation, normal levels of growth. I think in a way, we do kind of need a harsher landing to really shock people, to shock consumers. Hey, stop spending money. Don't get a $50,000, $60,000, $70,000 pickup truck for 84 months or whatever. Like, slow down. Like, you need to see more delinquencies happening. Unfortunately, you need to see more car repossessions happening in order for us to really change the affordability issue that's happening in the economy. A lot of people still can't afford homes and even decent used vehicles. Now here, Bank of America did a survey with their fund managers, and they quoted that 42% of fund managers said they believe a recession will come within the next 12 months, and 80% believe the economy will remain stagflationary over the next year or so. This prediction is up again since reaching its highest level since November. More and more investors, since what happened with the banking collapse and now what's happening with commercial real estate, a lot of the banks are sounding the alarm on the housing industry, on different sectors of the economy. Now, another interesting chart I want to talk about is this chart showing consumer debt service payments as a percentage of disposable personal income. So it's just showing how much debt someone has as compared to their disposable personal income. And right now, the rate is around 5.73%. And it reached its normal levels, I guess, pre-pandemic levels, because in 2018, 2019, it was around that 5.6, 5.7% range. When the pandemic hit, that really dropped because stimulus checks happened. People weren't putting themselves as much in debt because rates were lower too on top of that. But now you see that huge rise happening, but it's starting to flatten out. So it's going to be interesting to see if it does reach higher levels like it did earlier in the 2000s, where it went well over 6.5%. Now, we know unemployment is a good measure to see where we're at as a nation, especially economically wise. Looking at what happened in 08, 09, we see that unemployment rose significantly. Back in the 80s, same thing. And back in the 80s, I talked about this in another video where because there was inflation back then in the 80s, the Fed did the same thing that they're doing this time around. They raised the interest rate. But with that came higher unemployment. And so over the past year, we haven't really seen that uptick in unemployment like what happened in 1980s. So will this increase? And I think it's really important to see, like, the more it increases, the more we have of a chance of the economy crashing and the harsher the recession will be. It is unfortunate when you look at unemployment because usually when you have unemployment, prices of commodities go down, which actually makes it more affordable for most people. But then again, a lot of people are out of their jobs and so they can't afford anything at all. But it's an unnatural byproduct of taming down inflation, raising interest rates to make things more affordable. People unfortunately lose out of their jobs. But I think it's interesting that even though the Fed has been increasing the interest rate, unemployment has been steady. And maybe this is part of what the Fed is trying to do. I think the Fed is maybe like the income range, so people don't have as much money to spend, so inflation won't go up, but still keep steady people actually having a career, having a job where they can at least purchase their basic necessities. So if they can keep that and inflation go down, that would be a win for the Fed. All right, everyone, let me know what you all think down below of what's happening with big banks and them seeing a recession and then putting aside money in order to prepare for this recession. What does that mean for you? And what effects does it have in your daily life or on the economy as a whole? Make sure you subscribe, like this video, and I'll talk to you all later.